Hello, this is Edmund Shing from BCS Asset Management. And today we're going to look at the Eurozone. Is it a value play or is it in terminal decline? Here on page 2 we can see the Eurozone manufacturing surveys. As you can see, both the black line for the Eurozone and the yellow line, which is for Germany, both are falling and have been falling since January of this year when they hit their peak. So the sharp recovery in the Eurozone that we saw last year is fading away. This is weighing on the euro. The black line here on page 3 is the trade-weighted euro. The yellow line is the euro against the dollar. You can see that really since the middle of March, the trade-weighted euro has already lost 3.5% against major currencies. Now, this underlines the weakness of the economy, but also should help the economy by boosting exports as they get cheaper. Eurozone bonds have been falling sharply. This here is the EFSF 10-year bond yield. So this is from the Financial Stability Fund set up by the ECB and the Eurozone a few years ago. And you can see here that the yield has fallen from 3.5% down to just over 1% today. So the good news for the Eurozone is that funding these governments, such as Greece, Italy, Spain and Portugal, is getting cheaper. Equally well on page 5, the European Central Bank's balance sheet has actually been shrinking since the middle of 2012. What has been happening is that Eurozone banks who had borrowed very cheap money through the LTRO system have been paying the money back early. Normally, the money was to be borrowed for 3 years. However, banks have been giving it back before time because they have no use for the money. Returning to the industrial sector, we saw that manufacturing surveys were weak. Well, if we look at this chart on page 6, the black line shows industrial goods and services sector in Europe. The dotted line shows the relative performance against the broader European index. And as you can see in both cases, they are trending lower. So the weakness in manufacturing is hitting industrial companies in Europe. However, where we do see some strength returning is in oil and gas stocks. You can see that since late June, they've underperformed the market. Look at the orange dotted line, which is the relative performance of the sector against the overall market. But it has been breaking higher in recent weeks. So we expect to see further strength from oil and gas stocks in Europe. And also, surprisingly, from technology stocks. The black line is the technology index in Europe. You can see that in the last week or so, it has broken out of a resistance line, the red dotted line, and is following US technology stocks, which are the green line. They're following US tech stocks higher. And we expect to see further gains from European technology going forwards. So to summarize, do we see value in the Eurozone? We think the ECB will act soon. Remember that targeted long-term refinancing operations start this month, so they're starting to try to put more money into the economy to boost growth. Secondly, the weaker euro will help exports. It'll take time to work, but it will help in time. Sectors to avoid include industrials and also chemicals. But sectors to buy look to be oil and gas and technology in Europe. This is Edmund Shing from BCS saying goodbye.